All right, good evening. So what I wanted to talk about, some people just had a few questions about basic journal entries, accounts, transactions. So like I said, um, these are going to be real base level items. I see at least two names that I was like, oh, I know these people, they're my former students. Probably don't need this, but hey, that's how this usually goes. The really dedicated students are taking advantage of the stuff that more people should take advantage of. So I'm glad to see everybody here, whether I think you need it or not. Um, what one of the fundamental things that in order to work a journal entry, to understand like, well, what journal entry should be provided for this transaction, is you need to know the common accounts. So we're really just going to start at common account classifications first. And I'm going to just go through a list of things that will pop up again and again that you absolutely need to understand and have a sort of immediate, oh, this is a liability, this is an asset, this is equity, and more specifically, an expense, those types of real common accounts. And so all of these accounts, as we kind of suggest, as I kind of began the class on Thursday.
Um,
Yeah.
Sorry to interrupt you, but is there any way that you can make your screen bigger?
uh I I mean, it should be penned, and that's really should be mostly on you, on yours end.
Okay. Um,
Like maximize the window.
it's maximized. I just see everyone else, and your screen is pretty small, so
I
it's kind of
see.
hard for me.
Can you that so if you so if you hover over my tile on the,
Uh-huh.
and then there's three buttons,
Yes.
and then it should be like you can pin me,
Okay. Oh, perfect.
PIN.
Okay, that worked perfectly.
Okay.
Thank you.
So it's okay, yeah. I was like, oh, sorry, didn't mean to assume the level one tech support on you, like maximize the window. Anyway, so yeah, uh, the common account classifications come from assets equal liabilities plus equity. And I'm going to go ahead and separate equity into its two basic forms, which are the common stock portion, or the portion that is directly invested to us. And this also includes APIC. And I will do a short review of what APIC is and how it arises in a transaction, just for those, so you can kind of see, oh, that's why he said basically APIC is just common stock. And then retained earnings. So remember, of course, these are my two pieces of equity. Um, these represent the ownership in the firm, and in a really sort of rough, way, kind of speaking fast and loose, not at all technically correct or legally correct. But if we look at this is really the ownership of the company. Common stock and APIC represents what people have invested in the company, right? These are our owners. Retained earnings is what the company invested in itself, right? Because this is the earnings that it earned during a period that it did not pay back to its shareholders. So we got cash coming in from outside the company from people to buy ownership in our company. And then we have cash that the company reinvested in itself. That's retained earnings. So this comprises all of the equity within the company. Liabilities are, of course, obligations, and assets are, of course, the economic resources of the company. So common accounts under each of these. Of course, cash is the most common asset account. And cash is, the most primary liquid asset that a company will get. It's the primary mover of our economy. Accounts receivable. This is when we do something for a customer or provide a good or service, and they are liable to pay us, right? They have to pay us. They just haven't paid us yet. Accounts receivable, a lot of times we'll say the customer bought on credit. Uh, or purchased on credit. A company also has inventory. These are the goods that it intends on selling to its customers. Um, let's see. I'm just kind of working my way down, thinking of some of the things that are the most common. Many times we'll have prepaid assets. And don't be confused, because sometimes these will also be called prepaid expenses. And there's no difference between prepaid assets and expenses. They're both assets. It's just some people say, well, that's a prepaid asset account, or that's a, and others will say it's a prepaid expense account. We'll talk a little bit more about that with a specific transaction example in that simple example that I just loaded up and printed off my printer. So these are all not an exhaustive list, but these are the most common current assets. When we move beyond current assets, we start talking about a class of assets that many times uh, in the business world we'll call PP&E, which stands for property, plant, and equipment. So lots of things fit under this. The overriding litmus test threshold for classification here is that we are going to use longer than 1 year. So, for example, one thing that we talk about a lot in intermediate is supplies. Now, supplies I don't have listed up here. They wouldn't be inventory either, because inventory is things that we are going to sell. Supplies are a current asset because we're going to use them within a year. They would just be designated as an what we call it other current asset, but they're not really common enough for me to kind of give its own classification. Yeah. Let me mute this person. So these are all my current assets up here. The things that I'm going to use up within a year. And then after that, we start this list starting with PP&E beyond a year. So things that could be in PP&E, land, right? Any kind of property that we own, any buildings or facilities that are on that land. Again, no difference between the two, just calling them different names. Equipment, machinery, similar, no difference, just different names. I mean, you could kind of go on and on with this. Fixtures, right? These are all our tangible, durable things, right? So like the table I'm writing on, that's a long-term PP&E asset for my household. The house that I'm living in is a building. The land that the house is built on is land. Right. So companies will have a lot of these items. And, it could be computers. Well, that's equipment. You could call your, the desks that your employees work at equipment. You could call them fixtures. That doesn't really matter. What really matters is that you understand it's PP&E. It's an asset we're going to use for longer than a year. And it falls under the umbrella of this class of assets. The next asset chunk of assets are my intangible assets. And there's a lot of different items that could go under here. The nature of intangibles is that they do not have physical substance. So a lot of times these will be contracts, rights, and licenses. So things that the company is just able to use. Patents would be one type of an intangible. Copyrights are another type. Those are probably the two that you could be most familiar with. Software is my intangible, guys. And one class of assets I didn't talk about, investments. And investments could be short or long term. If they were short term, they would go up here with my current assets. If they were long term, they would be down here with the long term assets. If they're going to, pay off with beyond a year, then we would put them down here. And really, the only item that you might have seen in intro to financial accounting that would fit this is a note receivable. We'll expand on that a bit, especially in module 3 when we talk about the balance sheet. But for now, that's the only thing you really need to be aware of. So those are all my assets. And, it is important to know the distinction between current and long-term assets, what that distinction implies about how long we're going to use it for, and the common things that are included in those. For liabilities, the most common that you're going to use is accounts payable. This guy is for small frequent purchases for operations of the company. So small frequent purchases for the operations of the company. And or one very primary example that a lot of the time we invoke an accounts payable account is inventory. So company, instead of always paying cash for inventory when they purchase it, they will simply be billed by the supplier and then they will have to pay it. So one thing in accounting that is really helpful is to understand that there's often a very complete symmetry between accounts, and especially when it comes to transactions. So we're talking about accounts payable. A lot of times this would be the company would be signaled by words like the company purchased on credit. Right? And notice, very similar to the account receivable, someone is buying something on credit. And these guys are equal opposites of each other. If we think about a transaction between the company and the customer, right? The company sells something to a customer, and the customer does not pay right away, but will pay within, say, 30 days. Then at the moment we sell it, the company recognizes a receivable because we are owed by the customer an amount of money for whatever we provided them. The customer, if they were keeping a balance sheet on their own personal life and transactions, they would have an account payable because they would have to pay that amount of money to the company. So these are two accounts where if you look at the party and the counterparty to a transaction, right? Because it always takes two, doesn't always take two. It's someone, you can buy something or change cash into a piece of equipment. So that would just be really the company getting both parts of the transaction. But when you have two parties to a transaction, a lot of times there will be this symmetry of equal and opposite accounts. One party's receivable will be the other party's payable. Liability accounts are very highly flagged by the word payable, because payable clearly means an amount we're going to have to pay. So there's a lot of different accounts that we can evoke here, like we have to pay our employees, that's wages payable. We have to pay taxes. We have to pay interest. We have to pay dividends. So all of these payables, if we declare a dividend, then we have to pay dividends. I didn't mean it to say they are not inevitable like taxes and interest and paying people for their work for us. But when we do declare a dividend, we are legally liable to pay that dividend. So these are all payables that are frequently used frequently used current liabilities. There's another type of liability that's current. You probably know it from, or it would probably be remembered from intro as unearned revenue, just as a way of sliding into a more commonly used term, like kind of interchangeable. What I usually call it and what most of the accounting world calls it, I'm not sure why we start you off on a word and then like no one uses it really. It's a little bit more obvious than the idea of calling it deferred revenue. So unearned or deferred revenue, the same thing. This arises when we're paid in advance for a good or service yet to be delivered. So I'm the company. The most common or the easiest thing to think of in this case is a gift certificate. Right. I work at a restaurant, or I work for a restaurant. A customer brings me money and they get a gift certificate. They don't get anything from my company today because that's probably a gift. And I received that money, but I haven't done the work yet. So I can't record the revenue. In order to record a revenue, I would have to actually provide a good or a service. Since I haven't done that yet, I get the money, but what that money really represents to the company, besides the cash, is the obligation to perform a service or provide a good. Right. So the accounts payable, these payables, and unearned revenue, those are really your most common kind of current liabilities. And then finally, we get to notes payable, and we won't really talk about bonds payable in intermediate one. It's a related topic. But again, we have the symmetry between notes receivable and notes payable. And just like notes receivable, this can be current or long-term. So can deferred or unearned revenue. Because, for example, if a customer prepays us maybe for a 2-year subscription, then yeah, we are going to earn some of that revenue within the first year. So that would make it current. But then we're going to earn some of that beyond the first year. So then it becomes long-term. Any questions about any of these accounts, what they represent, or anything I said? And this is, again, not exhaustive list. There are assets and liabilities beyond these. But I was just trying to think of all the assets and liabilities that we will run into on the first exam at the very least. Or, could run into, not will.
Don't notes payable usually have an interest rate? Or did I miss that or something?
No, you're right on, Lucas. So and I was mentioning that in one of my classes, maybe both, I forget. But yeah, notes payable versus accounts payable. is the same distinction that accounts receivable and notes receivable have. So I'll just kind of write that out here at the bottom. Accounts versus a notes. They're both amounts of money that are owed if they're payables, or due to us if they're receivables. Accounts tend to have no stated interest. So there's no interest rates attached to to there's just no interest to it, because there's not, I was going to say, there's no interest attached to the document that we sign, but you don't even typically sign a document with accounts. You might sign your name on an invoice like you're going to pay it, but you know, it's not a formal written document like a note would be, whereas notes have stated, or typically have stated interest. It's not not required, because there are notes that have what we call implicit interest, but most of them do have some sort of a stated interest on them. So a type of note is a mortgage. A type of note would be a loan you get at the bank. Accounts are more just an agreement between the company and a customer, right? An agreement between two parties that something will be paid. Accounts tend to be for low dollar values or small dollar values. Oh, it's my favorite pen running out of ink. This is a sadness for me. Small dollar values. Oh my gosh. But you have to witness the passing of a favorite pen with me. It's a moment. Small dollar values. These notes tend to be large dollar values. Need to get some more of these types of pens. If you like ink pens, I'll put a shout out. Maybe they'll pay me at one point. The G2s, really good pens, especially the dark blue. That's my favorite color. But anyway, so large dollar values, stated interest, no stated interest, small dollar values. So, you know, we're thinking about inventory or customers buying things from us, right? Here we're thinking about taking out a loan from a bank, or if we're the people lending the money to somebody, then we have a note receivable if we're the lender. If we're the borrower, we have a note payable, right? So those are the kind of the distinctions between the two of these guys. When it comes over to the realm of equity, things get a little bit more dicey. For this class of accounts here, common stock and APIC, there are other types of stock, preferred stock, but don't worry so much about that right now. You know, we're the focus of intermediate one is not equity accounts, but common stock and APIC accounts are those are the two accounts that you would see under here. You know, technically speaking, you would also see preferred stock as this type of an account. The difference between common stockholders and preferred stockholders. Common stockholders are the true owners of the company, the residual interest. Preferred stockholders usually are in it for dividend payments. So there's just a difference in the clientele that usually purchases this kind of stock. Common stock, as the name sort of implies on its own, is more common. And it's also the more basic ownership of the company. Preferred stockholders don't get to vote in company matters. Common stockholders do vote in company matters. And then APIC is additional paid-in capital. And while we're here, I will kind of take a break from just listing things to just show you briefly on another page, because it doesn't really fit with what we're talking about, how additional paid-in capital arises and why it basically is just a common stock account. So all stock has what we call a par value. And basically a par value is the amount of money is the lowest amount of money that a stock can trade for. And so most companies set it at less than a cent. You probably see it as $1 in most of your classes just because it makes it simpler. You don't have to worry about the multiplying it by 0.01, use multiply it by 1. But yeah, that's usually very, very low amounts. And when we go through the balance sheet chapter, I'll show you some real world balance sheets where they just have this like insanely low, like $0.00000001 or something like that. It's essentially zero. It's so small. But the par value, besides legally having the implication that this is the amount of money under which the stock cannot trade, is also this sets the value for common and preferred stock accounts. So when we issue shares, let's say that I issue or sell, issue is just another name for sell, 1,000 1 cent par value common stock for $5 a share. So we have a public offering. We offer 1,000 shares. I didn't specify, but we have it's 1,000 shares of stock with a 1 cent par value, and we're getting $5 per share from that. Well, the way that I would make a journal entry from that is to first, what did we get or what did we give up? That's always something that I ask when I'm starting a transaction, because every transaction truly will boil down to we're either getting something or we're giving up something, at least transactions that happen during the period. Adjusting entries, closing entries don't necessarily follow that. But in this case, we're getting, right? If we sold them, cash. So we debit cash. And we're going to debit cash $5 a share for 1,000 shares. Then that is $5,000. And like I said, par value sets the value for common or preferred stock. So if I credit common stock as my ownership account, my equity account, then I can only credit it up to 1 cent per share for those 1,000 shares. So in this case, I would credit it by $10. And APIC comes in. APIC is the additional that people will pay for a share of stock over the par value. So you could think of it two ways. One way is, well, if I got $5,000 of cash and only $10 is assigned to common stock because of the par value, then the remainder, which is $4,990, has to be APIC. Or you could say each one was sold for 1 cent of those $5 is the par value. That means that it is $4.99 per share above par value. or in excess of par. And then we take the 499, multiply it by 1,000 shares. And that's 4,990. And that's my, and I'll spell it one more time because someone got into advanced accounting and they didn't know what APIC stood for. They knew what APIC was, thankfully. But they had just been hearing APIC so long, and I guess watching us write APIC so long that they couldn't tell the instructor what APIC actually stood for, and it was a moment. Right? If you ever are using an acronym, make sure you know what the acronym is, or that could be an embarrassing moment. All right. So that's what APIC is. And that's essentially why it's just ownership. That's why I say it's just really common stock. This separate designation is something that we do in bookkeeping. Most companies they're not required to show the difference between common stock and additional paid-in capital. If they do, they will. If not a big deal. They would just combine these two and report it as $5,000 if they didn't make a distinction. All right. So those are really the only common stock APIC accounts: common stock, preferred stock, additional paid-in capital. In terms of bookkeeping, common stock and preferred stock behave just the same way. They both have par values, they both have additional paid-in capital accounts, so no differences there. Retained earnings gets a little tricky because it really is comprised of, it itself is the retained earnings account. But we know that retained earnings is also, as I broke it out in class, any amount that we started with, so retained earnings at the beginning, plus net income, less dividends. So yes, retained earnings is its own account, but it is influenced by where it started, of course, but also what these other accounts are. Net income, as I mentioned in class, has a lot of pieces to it, has 4 more accounts that we have to consider. All of them affect net income. It has 2 that affect it positively. So retained earnings revenue adds to net income, gains add to net income, expenses reduce net income, and losses reduce net income. So real quickly, if you haven't seen module 1 yet, the difference between a revenue and a gain is just whether that transaction is part of what the company considers its central operations. So really the difference between a revenue and a gain is how frequently something happens. Because if something's happening frequently, if we're collecting money from customers on a frequent basis for some purpose, that likely is a revenue. If it's, for example, we are we deliver goods and services, or sorry, goods and services. We're a freight company. We deliver goods across the nation on a series of freight trucks, right? So we're a delivery company. That's our main operation. We provide services to people by shipping things in bulk. If we were to have to sell one of our freight trucks at some point, we just got all the use we could out of it, we wanted to replace it, then any amount of money we got over the book value of that truck that we sold, we would record as a gain, because that's not our central business. We're not here to sell the freight trucks that we're using. That would be the manufacturer of those trucks, right? We are a service provider that's providing shipping. Therefore, that's the sale of that big asset. It is not within the central operations of our company. And expenses and losses are the same. Expenses are those frequently occurring items for which a business is spending money, and losses happen much more infrequently. So that's the basic And yeah, you can see sales revenue, service revenue, gains and losses, gain on sale, gain on trade-in, loss on sale, loss on trade-in, expenses, right? Lots of different types of expenses. One expense that isn't called an expense, but is an expense. So I'm going to write includes cost of goods sold. That is an expense that's related to the cost of my inventory. We don't call it an expense, but it is one. Okay. And dividends are separate from any of these items. They are something that affects retained earnings, but they do not ever affect income. So those are the common accounts and the common account classifications. And, a quick review then from there is, well, what are the debit and credit rules for transactions? And this is something that if it's not in there, you've seen it, I hope, enough from your intro class that it should get back in real quick. So assets, when I say debits and credits, of course, in a journal entry, I'm referring to debits are the left justified account, which here is cash, and then credits are the ones a little indented to the right. Debit really just means it comes from, I think this is how you spell it, like a Latin, perhaps it's an Italian, debere. Anyway, I mean, Latin is the root of all the Romance languages, so it could be very close to the Italian, or maybe that is the Italian, but basically it just means left. And then credere is the credit, and that's right. So debits and credits don't mean anything like increase, decrease, good, bad. They just mean left and right. And kind of dovetailing off of that, when we think of T accounts for assets, this side is the left side of the T account is the debit side. So anytime I debit a transaction that's an asset, I put it over on the left. Anytime I credit it, I put it on the right. And that's true for all accounts. Debits on the left, credits on the right. Liability accounts. Same rules. Equity, sorry, I have an issue. The lines aren't really kind of straight, so then I draw another line to make it look more straight. I'll get used to it. So I'm going to start writing the other accounts down here. They're going to look a little weird at first, maybe not if you remember your debit credit rules. Yeah. All right. So I put on the left-hand side everything that is increased, and you'll see me make this notation a lot when we were learning a new account, like a contra account or a adjunct account. Oop, yep. No. There we go. All right. Now, these are all my debit-based accounts. These have normal debit balances. Normal debit just means that these things tend to have an overall balance that is a debit. Now, that is something to know. Yes, we can credit these accounts to reduce them, but it will never make sense for these accounts to have a credit balance. That's why normally they are debit-based accounts, and debits increase them. These are all, and again, I'm saying normal, because that's the jargon for that. These are all normal credit accounts. And I never want to say normal anymore, really. It's kind of pejorative. Like, oh, well, normal people do this. Well, that's normal. But hey, they're accounts. They don't have feelings, so it's all right. Normal credit accounts, credits increase these guys. And so if credits increase them, that means debits decrease them. And again, it doesn't make sense to have a credit balance of liabilities. Yeah, I won't get into it, but common stock and retained earnings. These two can have either. I know it's kind of strange. I mean, retained earnings, it makes a little more sense for common stock. Yeah. Basically, when a company starts repurchasing like mad, like when the tax rates dropped, this is what they did with their extra money. They repurchased tons of stock. It can drive that to the debit. But anyway, these equity accounts are the only ones that can really have either balance. Revenues, nope, they will not have a debit balance. Okay. So, oops. I wrote that big equation on the board. I said, this is where it derives from, right? This is where all this derives from. And then I made fun of dealer because I don't like acronyms. I think they're silly. Mnemonics. I mean, acronyms are fine. Mnemonics, using acronyms to learn something, I find it kind of silly. But what people are using when they say the word dealer is dividends, expenses, and assets. DEA, those are debits. LER, liabilities. I guess they're saying equity and revenues maybe are the LER, their credits. And so what I almost always see on the test, because someone taught them this, is someone writing this on the front page and then they write a line down the middle. And the DEA is on the left and the LER is on the right. Okay, if you want to use it, sure, go for it. But what I showed you in class should also be the understanding of where this all came from and why it works, right? It's not just an arbitrary fallout of, oh, I think, an asset should be the debit and we're going to give expenses a debit too. Yeah, why not? Sort of a negotiation process. So those are the basic rules. Now, these guys, yeah, you can derive that equation and you can move everything positive, and that will show you the things on the left-hand side of that equation are debit accounts and the ones on the right are credit accounts. And I do make fun of dealer a bit, but there really is no other way to learn this well except to work a lot of problems, and you'll get used to it. It'll start becoming second nature to you. Oh, I did remember one thing no, I didn't. Okay, it's there. Never mind, strike that, we're good. Okay, so that's the real basic piece of this. Now I do want to, hopefully you had some time. If not, you can follow along and look at this later. Follow along on your own notes, and then you can print it out later if you need to. But basically, this is just a real simplified example. I wanted to for this session to also be a sort of opening into the accounting cycle for us.
Sorry, I don't mean to interrupt. What notes are these?
So this is the one that at the very beginning I said I'm posting something on your module 2
Okay.
folder.
Okay.
So it's under that folder.
Yeah. Okay, perfect. Thank you so much.
Oh no, and don't worry about interrupting. It's fine. So real simplified example. Yeah, very few accounts. And I lie because I changed it. I changed it just right before this meeting. There's no accounts that require adjustments. I put one in there. I also put some receivables in there. There are still no long-term assets that require cost allocation, though. So that part is not a lie, even after I altered the document slightly. Now, notice that it starts off with what I'm calling the post-closing trial balance. Remember, this is actually the very last step of an accounting cycle, the post-closing trial balance. And this is created, as the name might imply, after closing entries are made. Okay, so after I make closing entries, after I close all revenues and expenses, gains, losses, and dividends into retained earnings, this is all that's left: my assets, my liability, and my equity accounts. And with any trial balance, the total amount of debits and credits should equal. So this is where we're starting from. This was made at December 31st, 2022. Now, this is the balance sheet as it would be created at that same date, December 31st, 2022. And balance sheets are best made from a post-closing trial balance because they will have only the accounts that a balance sheet would have. If you do an adjusted trial balance, then you're going to have some income statement accounts on there because they have not yet been closed into retained earnings. These are all the accounts, the values at which we would find them on the balance sheet. So we just bring all the amounts straight down, not a big deal, right? And put them into the balance sheet format, real simple balance sheet. Now, if we were trying to come up with a balance sheet as of December 31st, 23, well, then we'd have to recognize that this is just our start. This is basically our starting point. Excuse me, our starting point for the year 23. We have these transactions for the year 23. So I'm going to go through and journal these transactions as they occur. Notice there's no dates here because I'm just keeping it real simple. Like this could have happened over the course of the year. So we're not going to worry about dates right here. We're just going to learn the debit and credit rules. Purchased $22,000 of inventory on account. So I'm buying more goods that I can sell and I'm not paying for them now. I'm going to pay for them at a future date. So that is my debit to inventory. I asked myself, what did I get for this? Well, I got inventory. Well, what is inventory? It's something I intend on selling. It's an economic resource. And inventory is an asset account. How do I increase assets? I debit them. So I'm going real basic here. Later in the semester, I'll just slap a debit up and assume everyone understands, oh, that's an asset. I got it, so I need to debit it. And when I mean later through the semester, I mean definitely beginning exam 3. Exam 2 does not have any debits or credits in it. It's just all financial statements. And before you breathe a sigh of relief, don't, because there's a lot of other stuff in there. So inventory, debit for 22,000. I got this. I increased my inventory account, which also increases assets overall since it is an asset. Now, after I figure out what I got or what I gave up, I didn't really have to give up anything on this transaction. I just got something. If I get something, then I ask myself, well, how did I get it? Right? Did I have to pay money for it? Or am I agreeing to pay money on a future date? Or did I get it because someone gave it to me for ownership in my company, right? So those are all plausible things. In this case, I purchased it on account. So I got it by agreeing to pay money at a later date. And for inventory, as I mentioned, that's an account payable. For this next transaction, sold inventory. This one is going to be one that probably a lot of people need a refresh for. This is one that I find in intermediate people are the shakiest on at the beginning of the semester. And that one is It should be blurry. It'll go in and out of blurriness sometimes if I put my hand here or not, but it should recover and autofocus up.
Yeah, it's. Oh, okay, there it goes.
Yeah. So inventory that had cost 20,000 for a total of $77,000 to customers. So I sold inventory, it cost 20,000. That means it cost me, the company, 20, but I sold it for 77. And then from this, I say 50,000 was paid in cash, and the company billed $27,000 to customers who paid on account. So what did I give, or what did I give up? This one actually is going to require 2 journal entries. Okay. So what did I get in this transaction? What I got was $50,000 of cash and a promise from customers for $27,000 more. So that's the got part. And cash and the agreement that I'm going to be paid cash, that is cash, an asset. Assets are debited to increase them, and an account receivable. Because this is, I am entitled to receive, right? Something is able to be received. $50,000 of cash and $27,000 of a receivable. Both of these are assets. Since we're debiting them, those would increase. Now, what is the, okay, so I got this. How did I get it? Right. I got it by selling inventory. So if you, Tristan, if you open up that document, it's the very first page. It's not in the module 2 notes. It's called like simple exercise. The very
Oh, okay.
Yeah.
Okay. Okay.
Yeah. So I got it by selling inventory to customers. You could say, all right, well, maybe I should credit inventory. The problem with that is I cannot credit this inventory for $77,000 because it didn't cost me $77,000. It cost me $20,000. Right? But I provided a good or service, and I received consideration for those goods and services. So this would be sales revenue, or just revenue if you prefer. Doesn't really matter to me. Revenue or sales revenue is a net income account. Because it affects net income. All right. Now, the other part of this transaction, what do I do with this $20,000? Right? It cost me $20,000. This is where you might have said, well, yeah, I got cash and the ability to collect some cash, but I had to give up inventory. So where does that fit in? You're absolutely right. I had to give up inventory. Now, remember, I said, yeah, you wouldn't credit inventory for 77,000 because we record inventory at the cost that we paid for it. So when I gave up that inventory, I had it on my books for $20,000. So it's no longer there. It's not increasing. It's being sold to customers, and I have to credit that asset. So that's a give up piece of this transaction. All right. Well, what do I debit then? What did basically how or what resulted from giving up this inventory?
Would you debit the 57,000, the profit basically?
Not the, so you're kind of close, right? But then I wouldn't have, remember, debits always have to equal credits in these transactions whenever I'm doing a journal entry. Like I might have more than one debit and just one credit, or vice versa, or multiple debits and multiple credits, but all the debits that I make in a single entry have to equal all the credits I make. But you're super close because it's the 20,000 that was the cost of goods sold. And a lot of people do like to kind of make this sort of, oh, it's the profit, the gross profit from that transaction. But really, the gross profit is created by the fact that I have a revenue account for 77, and then I just reduced it by 20,000. And then that gives me the $57,000 of profit from the transaction. Just as a sort of means of remembering it, you are not going to have a situation. There's very, very few situations where you ever have a profit account. Because what we do is we just straight up record revenues and expenses, and then we let the profit be calculated on the income statement. Does that make sense?
Yes, sir. It makes sense. Thank you.
Yeah. So yeah, that's that piece. So this one is one that people tend to have a few issues with. It is one of the things that's on your homework, a transaction like this where you sell inventory and you get some in cash and some in receivables. So make sure you know this one for sure, or understand what's going on here. So cost of goods sold and expense. Then I paid $15,000 off with my suppliers. This is when, so I paid, what did I give up? I gave up cash. And what did I give up cash to do? I gave up that cash to pay off an account. So like I mentioned, always begin with cash. In this case, if I'm paying cash, then I would credit cash. And that pigeonholes me because I'm like, okay, well, I just recorded $15,000 of a credit. Then, well, what the heck can I debit? In this case, if it's to settle accounts with my suppliers, right, the people who are providing the inventory, then if I owed them that money, what can I now reduce? What account?
Accounts payable.
Yeah. So I don't owe them as much as I used to. I owe them now $15,000 less. And that jives with the liability rule that debits reduce liabilities. Then the next one, I paid $20,000 for rent on, sorry, I just dropped something. I paid $20,000 for rent on the property I was leasing. It says that the payment occurred at the beginning of the year and that $20,000 covers the entire year. So this is actually going to be initially, and I'll say, I will put a date on this at the beginning of the year, 1/1. If I paid that rent and I'm paying for at January 1st, I'm making myself good on rent all the way up until December 31st, then I am paying the amount of money. So that is cash being paid out of the company for $20,000. What am I getting for paying that cash? Basically, I'm getting the luxury of not having to pay cash again for rent. Okay. So what we call that is prepaid rent. Paid all my rent in advance. And that becomes an asset of the company because that's an economic resource. I have paid all my bills with regards to the property that I'm renting. for the entire year. We're going to see what happens at the end of the year in just a second, but I want to finish the during the year's transactions first. This is the one transaction I put on here that would have an adjusting entry. We paid annual salaries to our employees at the end of the year. So they worked for us all year. And then at the end of the year, we paid them. Hopefully, this is a very part-time job for most of them because this is not a large sum of money. I was like, it's funny. Some of the things that go through my head when I'm creating a problem, and I'm like, oh, that's not really realistic, and that seems really like a harsh amount to pay somebody. And so then I'll try to go back and start changing things, and I'm like, ah, screw it, just let it be. So we're paying all of our employees $30,000, which again, hopefully they're not depending on this as their sole source of income. But they've provided these services for me over the years. So in this case, the services are already provided by my employees. I am paying them cash. And then we would debit wage expense. If we had not made any adjustments over the year, we would have no wages payable that we would need to get rid of first, like amounts that we owed our employees that hadn't yet been paid. But in this case, we're just paying them what they're due for all of their hard work over a year. And the final one says I paid dividends of $3,000 to shareholders. Credit cash for $3,000. What did I pay to cash for? It was for dividends. Dividends are not a net income account. They never affect net income. They only affect equity. They affect retained earnings in particular, but retained earnings is an equity account. And then of course, credit to cash is an asset. So, something that I see that people do a lot, some things to think about. One thing is, notice there are no negative values in any of these journal entries, no negative dollar amounts. You will never have a negative dollar amount in a journal entry. If you are feeling like, oh, I want to make this a negative amount, usually what that means is you're debiting when you should be crediting, or crediting when you should be debiting. So, if you're like, but I want to debit cash a negative amount because I paid it. No. You don't debit a negative amount for cash. You just credit cash when you pay it. So that's one thing to consider. The other thing to notice is, and I see this a lot throughout the semester, of people who are making it harder, I think, than it needs to be. Cash is always an asset. If you invoke the cash account's name, then this has to be an asset. Now, whether it's increasing or decreasing assets, that depends on whether it's a debit or a credit, but it'll always be an asset. Revenue is always a net income. Payables are liabilities almost exhaustively, etc. Okay, so these would be the accounts this would be the journal entries that happen during the year. These would be sort of normal transactions that happen during the year. And I mentioned that there is one that is not, that has an adjusting entry. So during the year, transactions happen with tons of people, right? Our store's open, it's running its business, it's running its operations, all these things occur. At the end of an accounting period, right, you can kind of think of it as, hypothetically, right, the doors are closed and the accountants are in the back making sure everything is properly accounted for. So this is business is open and during the year, and this is closed doors, accounting period end. These are not official transactions. Sorry, closed doors, accounting period is ended. So the things that happen on this side are not transactions with the company or other entities outside the company. This is all accounting procedures. This is when we have step 4 plus. So basically steps 4 through, oh gosh, see, I even forget how many official steps there are in the accounting cycle. Four, five, six, seven, there's 8. Okay. I mean, this like that's a fact that you just really don't have to know. And then, I mean, I could list them all out, but counting them is a different thing. I was like, are there 7 or 8? I know that's one or the other. So these are steps 4 through 8. Step 4 in particular is adjusting entries, and that's the video that I want, you know, the series of videos I have you watching before class on Tuesday, because we're going to jump right into adjusting entry problems. So step 4 is creating adjusting entries. One of the things that we have to adjust for is if we have a prepaid asset account, any prepaid asset, right? Prepaid rent, prepaid insurance, prepaid revenues, which we really don't get into those, but prepaid rent and prepaid insurance are 2 kind of big ones. Then when we have this prepaid asset, well, yeah, we at the beginning of the year, we paid $20,000 of cash to establish it. But over the course of the year, we then used it up, right? And if we go back to that piece, it says I paid $20,000. It occurred at the beginning of the year, and $20,000 covers the entire year. So that's just going to cover me for 1 year's rent. Well, if this is at the beginning of the year, and now we're at the end of the accounting period, in this case, it's a year, then I have to make an adjustment to this prepaid rent account because I don't have it anymore. I've used it up because I ran my operations out of that place of business. And I don't have much room here, so I'm going to abbreviate. I don't have any more prepaid rent because now that's all gone. So PPD, prepaid rent, for 20,000, all that credited out. Now, what would show me that I used this up, right? How did this decrease? It decreased because I now can recognize rent expense as I used up an asset, right? I don't record it as rent expense at the beginning of the year because I haven't used it up. Here, wage expense, notice I was very particular to say I paid annual salaries to my employees at year end in the amount of $30,000. So this is their salary that they get based on a year, and I paid it at year end. That's why this was just a normal entry. This entry, on the other hand, or that's why I recognize the expense at that point. This entry, on the other hand, I'm paying cash up front for something I'm going to do over time. So if ever there was a case where you prepay your employees, first, I would like to have that job because then I could take all my salary and put it into a savings account and then work for it and earn interest off of it. Well, so I would be earning that money while I was earning interest, which would be fantastic. Not going to happen anywhere in this world, most likely. But because the rent was paid at the beginning of the year and we're using it up over the year, we're only recognizing the expense for it at the end of the year. Right? So that's that piece. And beyond that, I really just kind of wanted to cover up to that point. Now there's more into this problem where you would create an unadjusted balance for the company. You could create an income statement, some closing entries. It gets a little far into where we are right now. I probably will come back to this example in a future weekend video after I've thrown in a couple of things this week. But yeah, for now, I think this is a good stopping point for us. Because the next step, and I will do this one piece or just start it, The next step was, now that I have all these journal entries, I want to start keeping track of them with T accounts. And I'll just do 2 of them. I'll do, well, actually, I'll do 3. I'll do cash. I'll do the account receivable and the account payable. So for each of these, they have a beginning balance, and their beginning balance is where they ended the prior year. So you could take that information from the balance sheet. You could take that information from the post-closing trial balance. Here, it's already broken out into debits and credits. And so I'll just take it from here. Cash started at 30,000. So 30K is there. Accounts receivable, notice it's not here. So I did not have a beginning balance of accounts receivable, even though I put it on the debit side, even though it's 0, because this is a normal debit account. It's an asset. And then accounts payable is 5,000. That's its opening balance, and it's a liability. So it's a credit balanced account. Then I just look at how all these transactions did or did not affect these items. So the first one, I debited inventory, credited payable. So I credited the payable because I bought more inventory on account. That added 22,000 here with that entry. Here I got some more cash. There's some other accounts that we would put into a T account, but I'm just not tracking them because we're kind of at the end of our time here today. I can't ask any more time of you or myself in this moment. Account payable up here, 15,000 cash. Sorry, 15,000 to the payable and credit 15,000 to cash. So yeah, it's left over here. So we put it on the left over here on this T account. It's a credit here. So we put it on the right here. That's 15,000. And another $20,000 of cash here. Prepaid rent, we're not tracking. Another $30,000 of cash here. Not tracking wage expense. And $3,000 of cash here. So cash, unsurprisingly, usually has the highest number of transactions to it. Oh, and I forgot to record that debit to accounts receivable, 27,000. I threw in the accounts receivable because it was one of the accounts that did not have a starting balance. All right, once we get to a trial balance, this is what this line really denotes to me, is that we're at a point where we're at a trial balance moment. Because we've recorded all of the entries that would have happened during the year, and now we're creating the first trial balance, which is the unadjusted trial balance. And that's just going to be me reconciling these numbers, adding them up or subtracting them. So we got 30, 50, that's 80. And then we're subtracting off 68. So that leaves me with $12,000 here of cash. And that's its unadjusted trial balance amount we would see. Accounts receivable, much simpler, 27,000 because 0 plus 27. And then accounts payable, 27 less that 15. Remember, these are adding because we're credit based now. 27 less 15 is 12. And that's just coincidence that cash and accounts payable came out as the same amounts. Definitely not something to expect. That's usually a follow-up question when two things reconcile to the same amount in a particular problem. People are like, wait a minute, are you telling me? And I'm like, nah, it's just how the numbers happen to play out. Okay, so after we did that, right, we would do that for all the accounts. And then we take each of these balances and toss them into an unadjusted trial balance. So that is basically what I'm going to start with on that problem on Tuesday. we ended Thursday working through that practice problem for the month of January. I'm going to sum up all those accounts into an unadjusted, entity accounts, and then put them on an unadjusted trial balance. And then we'll kick over into adjusting entries, because that is the next step of the accounting cycle. So make sure, you get assignment 1 done. If you have questions over it, you can shoot me an email or come by my office. Try to have, someone asked if they could come in, and I was like, sure, you can come in before class, but just make sure you have most of it done. So get assignment 1 done, watch the module 2 videos, and at some point, please do watch module 1 video and the notes, and after you downloaded the notes for those. Are there any other concerns or questions that I can cover?
I have a question for you. On module 1, do we need to do the practice work, or is it just module 2?
You mean the problems?
Yes, on module 1.
Yeah, so there are ones that I think are very beneficial in module 1. I
Okay.
mean, doing them, like actually doing them, it might not be necessary for you to write out everything. Like, I think the very first case just involves a lot of questions
Okay.
about,
I was
what.
just concerned about, do we need to bring them to class, is what I
No,
was
so
wondering.
but no, just the ones that I pulled from there and put under the assignment 1 document.
Okay, perfect. Thank you so much.
No worries. But yeah, always do as many problems as you can, even if
Yeah, of course.
yeah. Okay. Good. Yeah. Any other questions?
Yes.
What's up?
For the module 2 videos, I looked at the
Oh.
first two, part 1, part 2 of module 2.
Uh-huh.
It did start halfway through the notes on step 4. Is
Right.
that to be expected?
Yeah. So because steps 1 through 3 are kind of just I just didn't feel like they needed a lot of explanation, over the top explanation. There is one piece of those contra accounts and adjunct accounts that I will pay some attention to in class. But yeah, basically the videos I do have videos that cover every single piece of the notes. But I found that perhaps that was overkill. And, because it adds like another hour of watching stuff and me over explaining in some cases certain items. So basically the videos are to kind of expose you to the hardest, what I believe are the harder parts of the lecture, or the parts that you're going to have more trouble with just grasping right away. And then I will supplement that with small light discussions in class of the first part of those notes.
Yes, sir. Thank you.
Yeah, of course. Anytime, Emerson. Anything else?
So
No,
would you, sorry.
Oh, sorry. Go ahead, Lucas. I'm sorry.
So would you really ever have a gain or loss in anything other than PP&E?
Yes. So you'll get gains or losses on any long-term asset that you sell. So PP&E, intangibles, investments. Those are the most common forms of those. But you could have, there's some accounts that are called gains or losses, like impairment loss. But mostly those are things you haven't seen yet. Because any gain or loss is naturally outside the ordinary course of business transactions. You could have like a casualty loss because of a fire or earthquake damage or something along those lines. So there are other types of gains or losses. They just don't occur with great frequency. Tristan, you had something else?
Oh yeah, I just wanted to say thank you for taking your time out of your evening to
Of
do
course.
this.
Yeah, of course.
I really appreciate it.
Yeah, my pleasure. And thank you for coming and being attentive and asking questions. Yeah, I just want to make sure that everyone kind of starts off on as firm a foot as we can. And it's been a hot minute. Like I said, I've pushed for this course to be taught, to be able to be taken right after intro, because there's really nothing in managerial that prepares you for this course. I think for whatever reason, universities have always had you do 2 principles courses, and then you go back to intermediate, and it's like, oh my God, I have to remember all this stuff and start advancing the football. No, that's not that doesn't seem right for me somehow, but that's how it fell out.
Well, I really appreciate it.
Awesome. Thank you for that. And y'all have a great evening. I will see you on Tuesday. And like I mentioned, if you have any questions, just shoot me an email.